To give you a little backdrop how we got started, Wayne started this office here shortly after, well, not shortly after, but got into the industry shortly after leaving the Marine Corps. It's important that I mention that because growing up, whenever I asked him how he got into the insurance industry, he said that when he went looking for a job, nothing available for a hitman, so the next best thing was to be an insurance agent. So that always stuck with me, but between working in the military and then switching over to insurance, he had a couple other jobs in there, security guard, and I think it was 11 hours at General Motors, maybe 9 hours one day, 2 hours the next, and decided that was not the route he wanted to go. And some reason he decided, or somebody approached him about selling insurance. And if you ask him when you get done here tonight why that person wanted him to come and sell insurance, my guess is you've got a better answer than he does, because he has no idea why this person thought that he'd be a good fit. But turns out he was, because we're all still here today. So Wayne started with MetLife back in 1973, okay, yeah. So he was there when they wrote the second insurance policy. No. So 1973, got started, spent a couple years doing sales, did really well because instead of taking the sales book that they gave him, the book of leads, which was the phone book from Flint, and starting in the A's, he suffered through some foul language and some hang-ups, life-threatening situations, and went to the Z's in the back and had a little bit more success making those phone calls because nobody had made it all the way through there. So from that point, Wayne had some success and he got awarded his own territory, which was Bay City North and all of the Upper Peninsula. So in 1975, you can imagine what that area was like. It was just booming and just gave him the opportunities that he needed to be great success, right? But within 2 short years, he turned that into the #1 territory in MetLife throughout the country. So pretty great feat for him, which then sent him to New York to be part of a president's council. All the time when you get with these big industries, if you're doing really well, the owners of the business, corporate level, want to know what you're doing so that they can try and push that down to the other areas that aren't doing as well. So after a couple of years of going out there, meeting with the VPs, telling them the story of how he meets with people, sees what their needs are, talks to them about financial planning, tax planning, insurance planning, and sets them up with a strategy that fits and works well for them, they said that makes a lot of sense. But we are an insurance company, so we want to see your insurance numbers better. So after about 3 years of that, he went out for the 4th time, got to meet with not just the VP, but the president, told the same story. President was just amazed at how well he was treating clients, taking care of things. And at the end of the meeting, the VP said, "That's wonderful, but Wayne, what do we need to do to get you to sell more life insurance?" So that was Wayne's last day with MetLife. Okay, came home to Michigan, surprised my mom with, "I don't have a job with MetLife anymore, and I'm going to start something of my own." Okay, so that's Meyer and Associates was born at that point in time, with the idea that we just want to find out what people are looking for, what kind of goals they have for themselves, and fill the needs and not have any corporate level trying to tell us what we need to go and do for each person. So fast forwarding from that point, we've made some changes in the office. 1995 rolls around. Wayne says, "I want to have a tax presence in our business." So we're going to have a tax specialist that can come and poke holes in the ideas that we're creating to make sure on April 15th that all of our clients don't get mad at us. Okay, so we make a suggestion. We want to make sure that from a tax perspective it makes sense. Now, Mike's claim to fame every time he's up here is that he came up with the name for this business. And because he has such an amazing marketing mind, he came up with Meyer and Associates Accounting Firm. Okay. Insert laugh, all right? So he wants it. I knew I would never live it down if I didn't give him the credit for that. So, but along the way, we made lots of affiliations with other tax firms, attorneys, insurance specialists to try and bring everybody to the table. So with the idea that if you peeled the roof off the building, you look down, you see the financial advisor, the tax planner, the estate planner, the insurance planner, all sitting together trying to make a strategy that fits what each individual client is looking for to help them accomplish those goals. So that's kind of the history of the office. Going forward, we have the same goals, which is going to continue to be better today or tomorrow than we were the day before. And with that, we've evolved, since 1975. We have computers now. We have cell phones. We have things like that. But beyond that, we've introduced, AI into our industry and all that kind of stuff. So, but the main driver of the changes that we've made along the way is our client base. So over 20 years, we've had focus groups and advisory councils made up of our clients to tell us the good, bad, and the ugly of everything that we're doing. And all of that to try and mold the business to fit everybody's needs and try and cover as much as we can, because everything that we think is important, you may not think is important, and vice versa. So trying to build that together, and our clients have been just a huge impact in how we do business today. So for the clients that are here, we thank you for being here, but also for making sure that you keep us in check of what we're doing right, what we're doing wrong. So that's kind of our story here. And so what we're gonna do is dive into the presentation here. Am I ready to retire? Because that's why you guys are here. You don't wanna listen to me talk too much about our office. So questions that we're going to cover today are the following. How much income do I need in retirement? Will my lifestyle change once I stop working? Have I planned for cost of health insurance? That's a big one right now. If I need long-term care, how am I going to pay for it? Will my money last throughout retirement? When's the right time to begin Social Security? And do I want to leave a financial legacy for my family or any other causes that I might care about? So we're going to try and cover this as much as we can, and we're going to be open to questions and things afterwards, but if anything jumps out that absolutely has to be said, we're going to dive into it. But first up, we're going to bring up a couple of advisors, and I think Adam is first, who's going to knock out a lot of answers to these questions.
All right, I'll try to talk loud enough so everybody can hear me, but if not, I think the microphone's here, or raise your hand, I can speak louder. But I was tasked with trying to, figure out how can you generate income in retirement, because for most of you that are still working, you're like a lot of people in the world that enough income comes through the household that you are able to pay all your bills and don't really have to think about, what potential ways am I going to replace that lost income when I do retire. So we want to take a step back first though and actually start with how much income do I want or need in retirement. So I'm going to ask a question. You don't have to participate, but feel free to if you want. Has anybody here in the past couple months been doing any form of budget or tracking expenses by a show of hands? All right, I'm glad Logan raised his hand there. That's a leading by example. So no, I'm glad to see some people have, because really if there's one takeaway from kind of my section here, I would argue that's probably the most important thing you, I, and anybody can do, because we might have some clients who, let's say they saved $200,000 in their lifetime and another client who saved $2 million. If I told you that, you'd probably tell me, well, the $2 million client has to be doing much better than the $200,000 client. But all of a sudden you start to peel back the layers and it's like, well, the $200,000 client, they can live on $3,000 per month. They've got Social Security, pension, all of this stuff that they don't really need their portfolio unless a lot of bad things happen, where the $2 million client, they've got 2 houses to still maintain, 2 mortgages, 3 car payments, and things don't look as rosy as it might seem on the surface. So what we're really trying to structure here is making sure anything we're talking about in terms of goals in retirement are realistic for what you're spending today, and maybe more importantly, what you want to spend in retirement. And a lot of that is not perfect, because just because you're spending a certain dollar amount today does not mean that is going to be the exact same dollar amount in retirement. Your lifestyle is really going to predicate how that all looks, because we might have some people who say, I never got to take those cruises, those trips, those vacations, and now I finally have the time and I'm still healthy enough to do it. We need to factor in those costs, right? Or maybe I'm gonna buy that place in Florida that I never had the opportunity to. So it's not a perfect one-for-one scenario, but at least if you can start figuring out where spending's at today, we've got a much better feel about what changes you might want in retirement and how to account for that. Healthcare costs are a big one, like Joe had mentioned to start with. I'm not gonna dive into that too much because Sharon gets the opportunity to share some great examples about how healthcare costs can be a big payment potentially, and ways to hypothetically or mitigate those costs depending on how you plan for it. Housing decisions are definitely a big one. I've kind of touched on it. Do I still have a mortgage that I need to account for? Am I going to downsize to potentially help with costs? Or maybe, man, I've got kids that haven't moved out yet and I still need to keep a place big enough for them. Taxes in retirement are kind of tricky, because you and I probably sit here and think, well, I'm not spending money on taxes in retirement, but we would argue you need to account for the money that goes out to it. And the nice thing about taxes, depending on how you plan for it, you can actually control to a certain extent how much money you're paying in taxes, depending on which accounts you're pulling from, how you've structured your assets allocation. We'll dive into that more later, but we're all probably gonna pay some form of taxes. We just want to pay as little as we possibly can. And then last thing, as Joe commented on, family and legacy goals. We've got some people who say, I don't need all of this spending in my lifetime. How am I most optimized to leave that to my church, my charity, my kids, whoever that may be? So can I spend to a certain level and still achieve that legacy goal if that's a priority for me? This is kind of a baseline graph that the average retiree might see their spending go in retirement. It's not going to be perfect for everybody. There's a lot of variables in here, but how we often see it is like the spending smile is kind of what it's called, because I drew a couple eyes up there. It would look like a semi-smiley face maybe. We often see that first 10 to 15 years, let's say I retired when I'm 60, probably healthy enough to do all of my traveling, my fun stuff that I didn't get to, so you might be out and about spending more at that point in time. Then maybe when I move to my 70s, 80s, and on, I might stick closer to home, right? Potentially I've got more grandkids that I don't really want to take those cruises that I did. I want to watch them as often as I can. So maybe not that you stop doing things, but you stop doing things that were potentially more expensive earlier on. Please remember, not the same story for everybody, but just talking about averages. And then in that late retirement, what can really get to us is long-term care costs, which Sharon again will elaborate on more, but you're talking upwards of thousands of dollars per month if you need some form of care. And there's ways to mitigate that and address that, but again, this is kind of what we often see in terms of spending, and a lot of our planning processes, focused on what do you think retirement's gonna look like and how can we plan for those things that maybe we don't want to spend money on, but we might have to depending on what our life or our health outlook looks like. And then lastly, this is kind of, the main question, right? It's like, all right, Adam, I've done it. I've got my budget. I know what I want to spend money on, but I've got my 401k plan, my Roth IRA, my traditional IRA. How do I actually go about creating income from my assets? So we, through the planning process, do a big look on saying, okay, here's everything you've got, and how can we actually get you the income you want or need? Logan's going to get into a couple different scenarios on how we could potentially structure distributions, but just know there's a ton of products in our industry that are available, but they aren't perfect for everybody. So we've got a bunch of tools in our tool belt, and we try to utilize the one that makes the most sense in the scenario. But if I pulled Joe off the street and Sue off the street, they might not get the same recommendation, because personal finance is personal. Social Security is going to be a big factor for most people sitting in this room in terms of replacing income. Brett will be up here after I am to talk about a bunch of considerations for that, but looking at kind of like the three stools of retirement income that some people in the room might have heard about, it's really Social Security. Pensions are kind of getting a thing of the past. A lot of people may not have those anymore, but let's say, you know, for our parents, grandparents, it was like, man, I've got pension, Social Security, and whatever I saved in retirement. Those made up the three stools. Social Security is still here for now, but conversation for another time. Who knows what that looks like in the future. Pensions are becoming a thing of the past, so it's really on that savings and investments at the top to potentially replace whatever you're not going to have for income. And then we threw part-time work in here. I know that sounds strange. You're at I'm a ready to retire seminar, and I'm up here telling you to go back to work, but you can often look at that as a way to possibly replace that pension that might no longer be there anymore. And we always like to make a note on tax considerations. As I indicated earlier on, it's kind of some control in, and I've just got a couple different points up here that more ideas and food for thought, like capital gains. In our tax code for certain types of accounts, certain types of investments, which Logan will talk to later, there are ways that, let's say, for example, I worked at Dow Chemical for 30 years and I've got a bunch of Dow Chemical stock because either I bought it or my employer gave it to me. There are ways you can actually sell a significant portion of that depending on holding period accounts requirements and actually realize minimal tax implications. So if we can get income you need and pay next to no tax, I think that's checking off multiple boxes there. And then how different accounts are taxed. We try to make sure that not just your asset allocation is in line, but actually like your asset location, which type of accounts am I holding certain investments in to really, you know, diversification to enhance after-tax returns. Because if I made 10%, but I have to pay 5% in taxes, you made 5% after tax, right? But if you made 7% and only have to pay 1% in taxes, you actually made more after the fact. So considerations to go into a lot of this stuff, super high level here, but yeah, we really, when we're building plans, we're looking at how everything plugs in together to make sure that at the end of the day, I feel comfortable that I can spend not just today and tomorrow, but for the next 30 plus years. And with that, Brett's gonna come up and get into Social Security more.
All right, hi everyone, I'm Brett. Tonight I get the pleasure of covering Social Security, in my opinion the most exciting topic, but I am biased. And really what I want to cover tonight is a lot of the popular questions that we get from clients when they're approaching retirement, Social Security age, and also give you guys some financial planning and maybe tax planning examples that we've run into over the years with clients. So slide one, Social Security misconceptions. I believe the biggest misconception with Social Security is when to claim it. And it's not one size fits all. So just because your friend or coworker might have claimed Social Security at 62 or deferred it, doesn't mean it's right for you. It really comes down to your financial goals and also longevity and health in your family. With Social Security too, I believe you could probably Google when should I take Social Security, and you can find an article that says you should always delay it or always take it as soon as you can. Also in today's day and age with AI, you can probably ask ChatGPT and say, when should I take Social Security, feed it all your information, and it will give you some sort of answer. But really you should be talking to someone who is knowledgeable with Social Security, all the ins and outs and all the nuances before you elect and claim Social Security. Wanted to point out that up to 85% of Social Security benefits may be taxable just at a federal level. You may have heard in the news last year that there was talks about a bill potentially being passed to make Social Security tax-free. Unfortunately, that bill did not pass, but what did pass was the One Big Beautiful Bill in the summer of last year that gave individuals over age 65 an additional $6,000 of standard tax deduction. So that was kind of like their compromise, I guess, with making Social Security quote unquote tax-free, but it is still taxable. You know, again, 85% of your benefit may be taxable. Social Security is tax exempt from a Michigan state tax level, so there's some benefit there once we do go on Social Security. And how Social Security is calculated for how much of your benefit is taxable, if any at all, is your provisional income. So that's taking your adjusted gross income, or AGI, plus any non-taxable interest, and then adding back in 50% or half of your Social Security benefit. And then how Social Security is calculated. So Social Security takes the highest 35 earnings years of how much you paid into Social Security, and it is inflation adjusted. So if you only paid into Social Security for 30 years, when you go to collect your benefit, you'll only have 30 years taken into consideration, and then those 5 years, they'll have zeros when collecting or calculating your benefit. If you paid in for 40 years, Social Security will take the highest 40. So if you're still working beyond those 35 years paid in, leading up to retirement, those high income earning years, maybe right before you retire, they're gonna take those high income earning years and replace it with your lowest income earning year, maybe if you started working 40 years ago. And again, they do adjust it for inflation and bring it back to today's dollars. There's two really big acronyms I wanna make sure everyone's aware of when looking at Social Security. The first one is PIA, and that can stand for a different acronym. But for Social Security, it's primary insurance amount. And that's the amount that you'll see on your Social Security statement, how much you're eligible to receive at 62, 63, and 64. That's your primary insurance amount. The other big acronym is full retirement age, FRA. And that depends on what year you were born. So if you were born after 1960, your full retirement age is age 67. If you were born in 1955, it's 66 and 2 months. If you were born in 1956, it's 66 and 4 months. So on and so forth, up to 1959, 66 and 10 months. And why that's important, if you decide to collect Social Security prior to your full retirement age, you just get a permanent reduction in benefit. So it's not a penalty, but you do take less collecting prior to your full retirement age. And then Social Security filing status. So on this slide, I just want to point out the different options that everyone has when collecting Social Security, and there's really three. So you can either file under your own retirement benefit at age 62 under your own earnings record. You could file under an ex-spouse if you were married for at least 10 years and did not remarry prior to age 60. Or you could file under a deceased spouse, what we might call widow benefits. So some examples that we've run into with clients over the years is if you are eligible for a widow benefit, you can take that as early as age 60. And in some cases, it might make sense for a surviving spouse to take their deceased spouse Social Security benefits as soon as they can, maybe at age 60, and then defer their own benefit to age 70. And the reason why you would do that is they could then switch to their own retirement benefit at age 70, where it would be the max amount that they'd be eligible to receive. But in the meantime, they're still collecting a widow benefit under their deceased spouse and still having some Social Security income coming into the house during retirement. And then with ex-spouse benefits, we actually ran into this with a client here in the last couple of years. Two clients that were previously divorced and then they were going to remarry. They were going to get married at age 59. We actually told them not to get married at age 59, wait till age 60. So then they could still collect under their former spouse. If they were to get married at age 59, they would have lost that benefit. And they were able to still collect benefit at 60 under a former spouse and then defer their own benefit to 70 again. So again, just some tips and tricks with Social Security, all the ins and outs and nuances that is really important to know before you decide to collect benefit. And then income limitations with Social Security. So these only apply before your FRA or full retirement age. Again, this is, I think, a popular question that we get, and it's, do my pension or IRA or 401k withdrawals count towards the income limitations with Social Security? And the answer to that is no, it does not count. It's strictly earned income or W-2 wages that Social Security looks at when you're on benefit. So if you're still working at age 62, not collecting benefit, there's no income penalties from Social Security standpoint. It's just when you're on benefit. And that income limit, once we're on Social Security, is $24,480 for 2026. And that is an annual number. One nuance here with Social Security is the first calendar year that we're on benefit, it's actually a monthly test. So if I decide to go on Social Security this year in November, I'm subject to a monthly test for November and December, and it's $2,040 a month, which is just that $24,480 divided by 12. And if I go over by $1, I lose that month of Social Security benefit I have to pay back. So I'm subject to the test for 2 months monthly. Once January hits, it is now an annual number. So I can go out and make 20 grand in January, and I won't be subject to any income limits or penalties from Social Security. But once I do go over that 24,480 number, I lose $1 of Social Security benefit for every 2 that I go over. And the penalties only apply prior to your full retirement age year, but then also once we reach that full retirement age, the dollar amount goes up as to how much we can earn in gross W-2 wages, up to $65,160. And that's just the months leading up to our full retirement age. Once we reach full retirement age, we can go out and earn $1 million a year, and there's no income limits as far as Social Security is concerned. And then this is just a financial planning example that I put together that we've run into with clients before. Let's say we have a husband and wife, they're both age 62. The husband is eligible for $2,500 a month in Social Security benefits on his own earnings record. But let's say he's in poor health and he has life expectancy less than 5 years. His wife, on the other hand, is also 62. She can receive $1,200 a month under her own record, and she has good health in her family, and she might live another 30 years because she has longevity. In this example, it might make sense for the husband to defer his own benefit and the wife to collect her own, to have some Social Security income coming into the house, because in the event that one spouse passes away, the surviving spouse only receives the greater of the two benefits. They don't receive both. So let's say the husband passes away at age 65, and at this point he deferred his benefit. It's now $2,900 a month. The wife would then be able to step into and receive a higher Social Security payout. She wouldn't get exactly the $2,900 a month. It would be slightly reduced because she'd be stepping at age 65, so maybe she receives $2,800 a month or $2,700 a month, but there still would be a step up in income that she would be receiving at the passing of the first spouse in this example. And then kind of how we would tie things back into our office with financial planning is we believe everyone should go through a financial plan, and how we view Social Security in our office is taking everyone through a financial plan, looking at all the options that you have available to you, and looking at the financial plan using our software, looking at your goals, financial profile, and just seeing longevity, what's the break even if we do decide to defer Social Security. Another thing to look at too that I'm actually working with a client with from last year was I had a client retire and received a severance package from his employer. And what we're doing this year, and I think possibly next year moving into 27 and 28, is we're gonna have him defer Social Security and his pension and live on the money that he was given from his employer as a severance. So he's gonna show next to no income for the year. And we're gonna take advantage of a low income tax bracket, convert money from IRA to Roth, max out the 12% bracket. And once he collects Social Security and his pension, he'll be well into the 22. So it's kind of a tax planning example that, again, we want to make sure we're aware of before we go in and collect Social Security. I think that's everything on my end. Sharon's going to come up and talk about health insurance.
With my glasses, otherwise I'm not going to be able to see. So hi everyone, my name's Sharon and I get the fun of talking about healthcare and long-term care. So first of all, I'm going to keep this super high level because the thing with health insurance and long-term care is I could do a seminar just on these things on their own, and I don't want to put you all to sleep tonight. So that's kind of my thing, because it can be. So first of all, we've been talking so far about income in retirement. We've been talking about planning for income. The one thing a lot of people forget about is the expenses of health insurance when we're coming into our retirement years, especially if we're retiring before the age of 65. I'm sure you've all seen the adverts on the TV around October, November time about Medicare, but what they don't talk about is for people who have retired before age 65. So when you no longer have health insurance through your employer, you've got you've got one main option, and that is the health exchange, or the marketplace is another name for it. The thing with the marketplace, the exchange, is yes, there's health insurance plans and there's lots of different levels, but they're not cheap. And so the cost can be significant, and that's the part we don't factor in. The thing that a lot of people don't realize is, depending on our income during those years, we can actually get subsidies, and the subsidies can be very significant for the premium to reduce it. In fact, you can have premiums that are basically zero. But there is what they call a hard cliff cutoff from an income standpoint. As a single person, the hard cliff cutoff when you no longer get any form of subsidy to reduce your premium is $62,600. And as a married couple, it's $84,600, so it's not doubled, which is a little unfair, but that's what the rules are. So I'm going to show you a couple of examples on health insurance afterwards. I probably should have moved the slide for you. Not that that's very interesting. But the next couple of slides, I'm actually going to give you a couple of examples of income impacting the health insurance. But before I get to there, the next part of health insurance is when we get to age 65. At age 65, that's when we go on to our Medicare, and that's when you start hearing about Parts A, Part B, Part C. There's many other different parts, or otherwise you hear about Advantage plans and supplemental plans. There are costs involved in pretty much all of it. Most people will not have a charge for Part A, which is your hospital side of Medicare. But Part B, you do have a charge, and for 2026, it's currently $202.90. Then there is a charge for Part D, which is your prescription coverage. And then if you want the extra for the Medigap supplemental insurance, then there's additional charges for that as well. So we plan for all those things. And really what we're saying here is we're tying this all back to planning. If we don't start with a solid plan to start with, then we're setting ourselves up for failure before we've even hit retirement. And that's what we feel very passionate about, is actually doing the planning side. I'm not up here trying to give you a sales pitch or anything like that. I'm just wanting to make you aware of the potential pitfalls in our retirement years if we don't plan for them. So that's kind of it from a very high level, pre-65 and post-65. As I promised, this is just an example. I have a married couple here, both getting Social Security, plus one of them gets a pension, plus they're getting some income from their investments. So they have a yearly income of just over $94,000 in my example here. Because this is a married couple and they're over that maximum hard cutoff number, because this is age before 65, this is less than 65. Remember, my cutoff number was 84,600. So they do not qualify for any form of premium reduction or ACA subsidy. So as you can see, if I look at the silver plan, that's a lot of money on a monthly basis for people to be spending on a married couple health insurance, $2,600 a month. Then, on the flip side, this is an example, pre-65, where we've only said take one Social Security. Right now we're getting some taxable investment income of $15,000. This is not just your only potential income, this is all coming to that planning. Where do we take money out of? And we've got many tools in our tool belt like Adam described earlier. But because this income is less than that hard cut cliff number, the 84,600, this means now you get subsidies, you get a premium reduction. The silver plan that we just said was $2,600 a month is less than $2 a month. That's a significant difference. The one thing I didn't say earlier is with these types of plans, the other part we really need to plan on is not just the premiums, but it is the co-pays and the deductibles, because they can be significantly higher than what you're probably used to with your employer-based health insurance. So it's another part of the planning aspect that we've really got to nail down. So, but here's just this is the example of just showing you the power of actually making sure the income is where we need it to be so we can get the most benefit at our certain ages. After that, I'm going to talk about long-term care. So long-term care, this is one of those things that most people do not plan for at all. I'm not going to sugarcoat it. And again, I'm not up here to tell you right now to buy long-term care insurance or anything. I'm just here to make people aware of situations. So with long-term care, why? Why does this matter? Well, it can be absolutely detrimental to a financial plan if we don't plan for it and we need it at some point. So it's a case that we just need to be aware of our options, and there are many different strategies we can use. But what can we do to help? It's a case that this is all about our activities of daily living. It can be, we need long-term care potentially because of illness or cognitive decline. It's not necessarily an accident that happens. And again, cognitive decline, for example, can be a gradual situation. So this is all to do with, though, are we capable of bathing ourselves, dressing ourselves, eating? This is not medical care. This is, actually somebody assisting us with our daily living activities. This type of care is not just in a facility. I mean, this can be in the home, or it can be assisted living, or it can be in a nursing facility. But who needs it? Well, let's be honest. The longer we live, it increases our likeliness of needing some form of care in the future. And as I said, it definitely normally starts gradually. One of the biggest drivers is cognitive decline versus, I say, and a lot of us think, if I need help, I've got my spouse, I've got my children. The problem with that is it's emotionally difficult, it's physically difficult to sometimes take care of somebody, and it can be financially difficult. If I ask my child to take care of me, they're working, they're raising a family. They may not have the time to be able to take care of me. And obviously that's a burden that I don't necessarily want to put on my child. So that's why, again, revolving this back to planning. We need to make sure we're planning for the future. How is it paid for? Well, Medicare does not cover this at all. If people tell you it does not. So what can we do? Well, we have to pay for out of pocket. Well, that can definitely have a major drain on our savings. And it can impact our spouse significantly, the one who doesn't need care. And if we have the plan for legacy, if we want to leave money to our children or charities, organizations, may not be able to do that at that point. You hear people say Medicaid is a safety net. Well, it is a safety net, but that's not a planning tool. So, Medicaid, you have to spend down assets, and you have very limited choices and flexibility. So, how do we pay for it? Well, you do have the option of long-term care insurance, and it comes in traditional forms, it comes in hybrid forms. But as I say, this is not a sales pitch, this is just making you aware that there are choices out there. But why do we plan before we need it? Well, again, health determines eligibility and cost if we're truly going long-term care insurance or a hybrid long-term care life insurance plan, and waiting reduces our options. Again, not everybody wants to do this, so what are the other options? Well, when we do planning, we are integrating your planning income, your retirement income. Maybe you do want to self-fund yourself and you're prepared for that risk, but it's a risk we need to talk about. You might hear on the news or the radio about estate planning or elder law planning. We're a huge advocate of making sure you've got your estate planning in place, and yes, it absolutely has its place because it does help people potentially get qualified if you need to go the Medicaid route, and estate planning can help in many, many different avenues of our financial life as well. I'm going to pull in again tax strategies. That's why we deal and have the CPA division of the financial group, is so that we can coordinate and we can make sure we're doing everything in the most tax advantage way that we possibly can. And the other thing is we need to make sure that we've got our spousal protection, because the person who's not going into the nursing facility still needs to be able to be taken care of. As far as the costs of these things, just up on the screen, average monthly cost of assisted living is over $5,000. That's a big chunk of change. Then we go into if we actually need skilled nursing or home care or nursing home. Now you're talking $8,500 or more. And that's just the basic. If you need more extensive medical care, you could be talking $10,000 plus a month. So it is incredibly expensive, and that's why we need to plan. So there you go. There's my big takeaway from today, guys, is the fact that planning is the most important thing, in my opinion, that you can do as you're getting ready for retirement. I'm now going to pass it over to Logan, who's going to go over some of the things on how we can actually get money out of our portfolios.
Hello, everybody. Like Sharon said, my name's Logan. And now that Sharon showed you how we're going to spend all of our money, hopefully I can show you how we can save some money and be strategic in the way that we can do that. So starting out, I think it's really important to stay goal-based in our investing. So let's say you're 18 years old and you're open up an investment account for the future, for retirement. You may invest in speculative areas of the market. You don't really care what it's going to do because I'm not using that money for another 40 years or so. So if it goes up, great. If it goes down, might not be happy, but you go to work next week, put some more money in there, and life goes on. Once you're 65 and you're relying on this money to support your retirement and your lifestyle, it becomes a different story. So if that's our goal with those monies to support our lifestyle, we may not want to be invested in the most risky areas of the market. We may want to be invested in ways that can provide income for us. Like Adam said earlier on, we want income for today, tomorrow, and hopefully for the next 30 years. So we want to create a reliable retirement cash flow, prioritize longevity, and if there's anything left over at the end, leave some money onto heirs. So there's a few different income strategies in the industry. I'm going to go over them with you. The first one up here, it says it's the bucket approach. So think of it as like a three-tiered bucket. So we'll have a bucket up top, in the middle, and then down at the bottom. So our bottom bucket is going to be that 0 to 3 years. So in there, that's going to be our 0 to 3 year spending money, money that we think we're going to need in the next 0 to 3 years. So with those monies, we're going to want to be really conservative. So think like cash, money market, maybe some bonds, something like that. So conservative assets. Our 3 to 10 year monies, it says balanced growth up there. So we're going to introduce maybe some equities into there for that bucket of money because we want it to grow a little bit. We still may have some fixed income in there because we know we're going to use it in the kind of intermediate term here, but we want to provide some growth, and periodically that balanced growth bucket, it might tip over and fill up that bottom bucket that's going to fulfill our 0 to 3 year of spending money. And then at the bottom, that 10 plus year money. So think of that as long-term growth. So that can kind of be gas on. We want it to be aggressive, knowing that we're not going to use that money for the next 10 plus years. So markets are going to cycle, do their thing. If we go through downturns, it's not the end of the world because we know we have our other two buckets that we kind of prepared for in a market downturn that we could not draw on depreciated assets. And likewise, when that 10 plus year bucket is up, the market's doing well, that's going to pour over into that 3 to 10 year in that 0 to 3 year bucket as well to periodically go ahead and refill those. Another rule that you may have heard of is called the 4% rule. So we save money our whole lives, and then that's kind of the easy part. You're just stacking money away. Once it comes time to turn the key and start relying on that money to provide for your lifestyle, it becomes a different story, the spend down part of it. And so kind of a rule of thumb in the industry, it's the 4% rule, and that's spending 4% of your money every year. And there's kind of two variations of it. So we have up there, if you had saved $1 million, what maybe you could count on that portfolio to provide you for your retirement period would be $40,000 a year in that example there. And the kind of the variation to it would be adjusting that 4% every year. So if the market's doing well, let's say I started at $1 million, but it grew to 1.5, I would have been adjusting my withdrawals upwards along that time period there based on that portfolio value. Likewise, if the market was poor and it went down, then your income would drop with it, drawing 4% off of a smaller portfolio value. Next up, asset location. So the other big thing for us is thoughtful asset location, and that could really help us out. So it's my favorite slide because I can talk about Michigan basketball. So if you look at some different retirement accounts and think of them as like players on a team. So if you have a 7-3 center like Mara, you're going to want to put him where he's going to do the best. You put him down low where he's going to get rebounds, he's going to block shots. That's where he's going to do the best. If you have somebody who can shoot really well, you're not going to put him down low. You're going to put him, on the top of the key where he can shoot, score, help the offense. Just like that, accounts, they have different things that they're good at, and we want to put them in the right areas to provide the best success to us. So first up there, traditional IRAs. So what a traditional IRA is we save pre-tax into those. So through our whole working career, we're saving pre-tax, so we're getting a tax advantage today. So let's say you'd saved $100,000 into like a traditional IRA. You're getting a tax advantage, so you never pay tax on that. Now let's say that grew to $250,000, and you said, okay, it's time to start using that money. When you start taking it out, you're going to pay tax on both what you put in plus a growth on it at whatever your tax bracket is. So knowing that that's how that works, your tax when money comes out of it, it says up there income assets, so it may make sense to put income producing assets in your IRAs because we know we're taxed when money comes out, but you could trade that account as much as you want and turn it over as much as you want for the actual trades within inside of the account. It's not a taxable event. It's only when money actually comes out of it. So maybe we put our income producing assets in there because we don't want it to grow, too large because we know it's going to be taxable in the future. But we also know we're only paying tax when money comes out, so maybe some income producing assets may make sense in there. Second up there, it says Roth IRA. So Roth IRAs can provide tax-free growth to us if we follow the rules with them. So Roth IRAs, so I'll do the same example. Let's say you saved $100,000, you would have been paying the tax up front, and then you'll have tax-free growth on those monies. So let's say you saved 100 and it grew to 250. When you go to take that money out, it wouldn't be taxable to you as long as you meet the Roth IRA rules there. So that kind of lines up with like that 10-year growth bucket because we want it to be gas on. We want to try to grow the Roth IRA as much as we can, knowing that we potentially have a large tax advantage in the future. And then the third one up there is taxable accounts. So if you've ever heard of like a joint account, TOD account, individual account, that's what a taxable account is. And that kind of has a unique mix of tax rules. And so coincidentally, that kind of lines up with like that 3 to 10 year bucket. So in taxable accounts, you could pay something called like long-term capital gains, which is a lower tax rate than what our income tax bracket is. Or you could even take something called like losses in there. So if it made sense and you had positions at a loss, you could sell them, capture the loss, offset some gains, maybe help offset some income, something like that. So it's kind of a Swiss Army knife and falls in between those two. Next up, withdrawal strategy. So talked about thoughtful asset location. Thoughtful withdrawals are going to help out a lot too. So first up there, it says use QCDs for charitable giving. So a QCD stands for Qualified Charitable Distribution. So that's something that we're able to do once we're age 70 and a half. And we use our IRAs for those. So once you're 70 and a half, let's say you go to church and you tithe and you're 70 and a half and you had always been taking money out of your IRA, it goes to your bank and you just write your check from there. Well, once you take that money, you're paying tax on it. Then it's going to whatever charity you're giving it to or church. So they're giving whatever the net proceeds of it is. If you do a QCD, it would basically go right from the IRA right to the charity or church that you're giving it to directly. And it would still come from you. It just kind of cuts the tax out of it. So you don't pay the tax on it, so it could, help your bottom line, your taxable amount for the year. Plus, it could put more money in the charity's hand. And it also reduces something called a required minimum distribution, which is going to come into play down the line once you're 73 or older. So QCDs can help with RMDs as well. Next up, it says Roth withdrawals for tax control. So we talked about saving in a Roth IRA. Roth withdrawals, they don't actually count towards your taxable income for the year. So let's say you're retired and you want to buy a truck and you need $30,000 to go and do that. And so we're taking a look at what our taxes look like. What's it going to look like if we take out that money? Not only will it impact taxes, but it'll impact healthcare as well. And something called IRMA for Medicare. And like Sharon had mentioned, even pre-65, there's going to be some significant healthcare costs. So we're looking at all those different things, and we can say, hey, maybe we use Roth money for this because it's not going to bump up our taxable income. It's not going to make us pay more in Medicare costs, make us pay more in potentially healthcare exchange costs. And third up there, it says harvest gains or losses. So that taxable account, periodically, maybe it makes sense to fill up that 0 to 3 year bucket. So we look at our taxable account, and maybe there's losses that we can take to help our bottom line in taxes to kind of refill that bucket. Maybe there's something in there that we've held for a while, and we could pay a long-term capital gain on it and pay less tax than we would out of maybe an IRA. So there's a lot of different things to be thinking about and wanting to put everything in the right place to kind of fulfill your goals and make sure you have as much success as possible. And then bottom line there, it says reduce taxes and Medicare costs, and hopefully at the end of it, reduce stress too. And so final takeaway, taxes are a big part. We have to plan for them. Structure is gonna improve efficiency. We wanna avoid unnecessary tax as much as possible. We don't wanna pay a penny more in tax than what we have to. Kind of an example that Mike and I were talking about before this, we see people who have those after-tax accounts and they're paying, dividends, capital gains, interest in there throughout the year. So maybe you have $20,000 as a tax bill from your after-tax account. At the same time, they're taking withdrawals from an IRA to fund their lifestyle. So it can almost feel like it's a double tax in that sense, where I'm paying here, I'm taking it out of there, but I'm paying tax again. So sometimes, Mike says, maybe a switcheroo should happen to where we have those income producing assets in the IRA, or maybe you just live off that after-tax account since you're already paying the tax on it there. Then it's important to review regularly. Laws, regulations, they change every single day, it seems like, so we learn something new every day. It's important to stay on top of it, and just continue to review your strategy. So with that, Joe's gonna come up here and take us home.
So again, I wanted to thank everybody for coming. I think it's important to note that the information that we covered today was it was high level. We did our best to try and bring it right to your plate so that it's relatable to the things that you have going on in your life. But I think one of the key takeaways that can be added to that list is that everything is so personalized that we cannot just come in and say, everybody in the room needs to do this. You all need to draw Social Security at this age. You need to withdraw from your Roth IRAs for this purpose or your IRAs for that purpose. How's Medicare gonna affect everybody is not gonna be the same. So taking time and getting into some sort of planning aspect, taking a look at these things from a personal level is definitely gonna help over the long term. So if there's any questions, we're here. Anybody that wanted to cover anything that they think is good for the group?
I would just ask, I thought the whole government shutdown 6 months ago was about those subsidies going away, and then you were saying the subsidies are still there, and you're like, those are the second subsidies on the extra stuff, and I'm like, I don't understand that. I thought that's why we just had a government shutdown.
Yeah.
You're correct. We had a government shutdown because
Wasn't that the fight over?
it was the enhanced subsidies. So back when, 2020,
Or is it not?
It can be, but it's it literally is a very significant step up as soon as you hit over that number.
Mhm. Yeah, I want to say if your income is somewhere in that 80,000, it's around 600 to 700 a month.
Yes.
And then if you jump to that 84, you're at 2,200.
Yes.
It takes a massive leap.
I'm sorry.
So we're talking that if your income is 84.6, like Sharon said, no subsidies, $2,200 a month for that silver plan. Or if your income was that 80,000-ish dollar amount, so just under that cliff,
Yeah.
payment would be somewhere in that $600 to $700 range for a married couple. So there is a gradual scale, but once you hit that 84, you're on your own. And those don't include, Sharon didn't put up there the deductibles that go along with those. So I think that bronze plan at $1,800 a month for a married couple has a $16,000 deductible as well. So
Now you see why planning is so important.
right. Yes, sir.
Well, you get to make 60,000, 62,000.
So a
That's
lot
why I
of,
was asking if it was a scale or.
a lot of people that we talk to who retired 5 or 10 years ago, they all say, I should have done this years ago.
Okay.
I never hear anyone ever say, boy, I sure wish I worked another 5 years.
Yeah.
Do you see clients like that, you know, even though they plan cautiously, because I think more or less we all plan cautiously,
Yeah.
as you need to, but do you see people that said, should have won a few more years? But it's almost always the other way, it's just,
Yeah, and I think what we run into is that the people that are doing what they're supposed to be doing are financially ready before they're emotionally ready, and they just don't pull the trigger. So that's the scenario you're talking about. There are probably more people out there that are forced to work, not just making the decision to stay longer because they're just not emotionally ready. They're fearful that they're making that decision too soon. But yeah, I don't know what the statistics are, but I'm guessing that they're pretty low of the people that are financially prepared long before they're actually emotionally ready to walk out the door. It's a big deal. You know, you're giving up a $60,000 to $200,000 income somewhere along there, and then all of a sudden you just got to say, all right, I'm going to rely on the government to send me a check, which I've been waiting for 6 weeks for my tax return, or my pension from a company that pensions are going away because they're not affordable. So that means it's a burden to that company. And then you've got a stock market that is volatile. You know, we sneeze and something changes. You know, we're a huge part of the stock market, way bigger than our parents were, as individual investors. And with 24-hour media and the information that seems to be relevant, that really isn't, causes us to make knee-jerk reactions on everything. So, you know, there's all kinds of factors that play into it, and just yes, ma'am.
Are there people that shouldn't be planning? Are there people that are it's too early to come see you? Never.
Yeah. No, I think Brett or Adam met with somebody this week that was 23 years old. Yeah. Yeah. Well, and sometimes, you know, when folks are young, a lot of times maybe it doesn't make sense that they are hiring somebody to do a service. But what we do with everybody is take them through a financial plan. So this young man, he may be just getting started, but he's going to go through a financial plan. And even though we're going to be planning for something that's 40 years down the road, and he has no idea how life is going to change for him once he's married or has a kid or changes jobs, changes locations, we're still going to give him a glimpse into what the world can look like based on everything we know, and he can make decisions from that point. But we want to make sure everybody has something when they walk away from our office that is valuable.
You know, when you guys do your simulation model with the little gas gauge graphic, and, does that include scenarios where a person or a couple would need long-term care and would be paying those kind of costs that we saw? Does it include that kind of a catastrophe in there?
So yes and no. So there's the part that we look at for retirement, and we use a simulation model that is it's like a Monte Carlo simulation where it goes in and says we're going to have 1,000 different types of stock market activity, your withdrawals, all the things that you're trying to do for your retirement. It's going to create this gas gauge and tell us what your probability of success is. We talk about that during retirement. Then we have another spot in there that we can go in there and say, hey, Bob, you're going into a nursing home at 80 years old, and you're going to be there for 3 years. How's Shelley going to survive? How's it going to look for her? So we do have the capabilities of trying to run some of those scenarios, but the cost of care is going up. I mean, Sharon threw those numbers up there. They go up dramatically year after year.
Now, is it the same from state to state? Only like, I'm a New York girl, and it's like 10 times more expensive when I'm in New York versus living here in Michigan.
No, depends on where you are.
Yeah.
And
Yep.
I didn't know if those were like national.
No,
or
that's Michigan.
Yep. So you want to find the cheapest state, move there.
Connecticut has some.
Yeah, right. Yeah, no, a lot of stuff is just geographical. And Sharon mentioned the insurances that are out there. Those premiums aren't fixed and they're geographically increased. So if there's a big influx of people in Bay County that end up going into a nursing home, they've got the ability to go in there under the contracts and raise rates 10, 12. I mean, we've seen as much as 90% rate increase in 1 year. Yeah. So we are going to hang around here if you've got questions individually. But again, really thank you for coming in. And if there's anything that we can do for you in the future, let us know.